With interest rates between 6 and 7%, how can you get a rate around 4% to save hundreds or even thousands a month in your monthly payment? We're diving into assumable loans, pros and cons to them, and how you can use them to score a much lower monthly payment. Or if you're selling your home, to use them to market your home to more buyers and perhaps get a higher selling price. We're covering everything you need to know in this video about assumable loans. Hi. Neil here. If you're looking at buying a home but you're stunned by the monthly mortgage payments that come in around 6 to 7% interest rate, it could be that an adjustable loan could be just the ticket to save hundreds or even thousands of dollars a month. And if you're selling a home, the assumable loan can help give you a tremendous marketing advantage to sell your home. And we're covering all that in this video. Assumable loans aren't really talked about until interest rates get high like they are now. If you're looking at buying or selling a home with an assumable loan, just reach out via phone, text, or email so we can run through your options. I've got people contacting me all the time just like you who have the same concern, and I absolutely love helping them. Now, it's important to note that many agents just don't understand assumable loans. So you really want to make sure you're working with an agent that understands assumable loans, like myself, to help guide both buyers and sellers through the process. So just call, text, or email me and let's chat. First, let's cover what an assumable loan is before we cover the pros and cons. An assumable loan is simply a loan that can be taken on by a buyer. So the buyer assumes the monthly payments of the seller and the interest rate. So if a homeowner has an interest rate, let's say of 2.75%, the buyer takes over the payments with that interest rate. There is a catch to this, and we'll cover that in the buyer cons coming up in just a few minutes. However, not all mortgage types are assumable. Typically, VA loans and FHA loans are assumable, as well as USDA loans. Conventional loans typically are not assumable. And some adjustable rate mortgage, or ARMs, will allow an assumption, but that kind of defeats the purpose since they tend to adjust, up and down quite a bit. VA loans represent the biggest opportunity because they typically have the best interest rates, and they are almost always assumable, and they can be assumed by a veteran or a non-veteran. The buyer also doesn't have to be a first-time home buyer. So selling to a veteran is best for the seller of the home because it allows the seller to regain entitlement and allows the seller to go out and buy another home with a VA loan. If selling to a non-veteran, although the seller has no obligation to the mortgage, the entitlement is tied up to that property and cannot be used by the VA loan again until the buyer pays off the loan or refinances out of the VA loan. Many VA loans have rates around 3%, which makes it super attractive to a buyer. Next up are FHA loans. FHA loans are always assumable and can be a great opportunity for the lower mid-price range homes. USDA loans typically are also assumable, and they're going to be for low to more moderate incomes. The buyers must meet the strict income limitations in order to qualify for the loan. Here are a few rules to keep in mind before pursuing this too far. The buyer must be an owner-occupant, so you have to be buying this as your primary residence, not an investment property. And the buyer must, of course, qualify for the loan. And the seller must typically have lived in the house for at least 1 year before doing this. So let's cover some of the pros and cons to the program. It allows the buyer to take over a lower interest rate. Typically, you're going to be dealing directly with the loan servicer, not a loan officer. That saves you some closing costs like origination fees. And you're only paying the remaining payments. So maybe 25 years are left on the mortgage rather than 30 years, for instance. This is going to save you some interest over the long run because of the 5 years less of payments. Now, let's look at some of the cons to the assumable loan for a buyer. First, you're going to have a high down payment. There really is just one main con to this, and that is there may be a substantial down payment required. Only the remaining loan amount can be assumed by the buyer, and the buyer will then need to cover the cost between the purchase price of the home and then what's left on the mortgage. In other words, the amount remaining to be paid on the mortgage. And the house is being purchased, let's say, for $600,000. The buyer would have to pay the difference of $300,000. There are a couple of ways to overcome this if you don't have access to that kind of cash. Number one, you can use gift funds from family and friends to cover the difference. Two, you can get a second mortgage through a lender to cover the difference. Three, you can use seller financing to cover the difference. So you'd make arrangements to the seller at an agreed interest rate to cover the $300,000 difference in our example. If the seller charges 6% interest and you're taking over a loan with 3% interest, you'll have a blended interest rate of 4.5%. Now this is a huge win. It allows you to buy the home potentially with no money down, allows the seller to get their desired price, and the seller makes a little extra money on the interest payments. Let's look at the pros for the seller. First is the increased marketing exposure for your home. With high interest rates, you can advertise that a buyer can take over a 3% rate, for example. It's going to help attract buyers to your home. A realtor who understands assumable loans, like myself, sitting on a gold mine to market your home and bring a bigger pool of buyers. This helps create demand and get the price you want. Using the seller financing option I just talked about will also help you net you the interest earnings on top of the sale. Let's look at some cons for the seller. First, it can take longer to sell your home. You and your realtor need to know everything about what the servicer is going to require and how long it will take. Servicers aren't as familiar with this because they haven't done them in a while. Things could take longer and the exact close date, may be unknown. A second con is entitlement for VA loans. As mentioned previously, if you're selling to a non-veteran buyer and your entitlement will be tied up, making it very difficult to buy another house using a VA loan. Third is qualification of the buyer. The buyer won't be fully qualified until you get into escrow because they have to get qualified with your loan servicer. Hopefully they're already pre-approved by a lender. Then they have a high probability of being approved by the loan servicer. Let's look at some of the best practices with assumable loans. 1. As a seller, you must get a release of liability from the loan servicer and sign it so you aren't on the hook if the buyer doesn't make the mortgage payments. 2. Talk to your loan servicer at least a month before you put your home on the market. You want to have all your ducks in a row on this before you list your home. 3. Marketing has significant advantages if you have this option because you'll get a lot more activity on your home. So make sure you promote this in all of your marketing materials. Number 4, as a buyer, you want to focus on homes sold in the last couple of years. Otherwise, the seller could have a ton of equity requiring a second loan or a significant down payment. And lastly, at number 5, make sure you're working with an agent like myself that understands assumable loans so they can work with the servicing, mortgage officers, and helping the buyer and their agent all the way through the whole process. If you're looking to buy or sell a home using an assumable loan or any other loan product, then make sure you reach out to me via text, phone, or email for a no-cost, no-hassle obligation consultation. I've got your back if you're buying or selling a home here in the Palm Springs area. Now that you know more about assumable loans, be sure to watch this video next to learn more about living in Palm Springs.
Because a home buyer may have to pay a lender some